introduction. I'm Stewart Hall. I am the CEO of PPHC. For the past 10 years, we've been in operation, slowly building what we believe will be and is already the largest U.S. Policy communications and advocacy network for service to provide strategic advice to our clients. Prior to that, I had sold a direct advocacy federal firm in Washington, D.C. to WPP. Roel?
Hi, my name is Roel Smits. I spent almost 3 decades in private equity, M&A, and CFO leadership. And of those, I spent 18 years at WPP, both in the parent company as well as at the subsidiary Kantar, which is these days owned by Bain Capital. And I joined PPHC 2 years ago as CFO, and working there together also with a lot of fellow WPP alumni.
Thomas Gensemer here, a similar story to Stewart. Operated or founded and sold a business to WPP that was in the government relations and campaign services world. Reconnected with him some years later, and we're sort of applying the lessons, good, bad, and others, as we build construct a buy and build model around this axis of client spend.
Go ahead. So in brief, what does PPHC do? PPHC helps corporates and NGO clients navigate the risk and opportunities of the government relations market. Corporates and NGO clients navigate the risk and opportunities of the government relations market. If you look at these charts here, this really shows exactly what has created our market and our market opportunity. And this is strictly in the US side, but you can overlay many of these metrics onto any developed democracy in the world. The trend lines look almost exactly the same. Both US spending and significant regulatory actions over the past 25 to 30 years have increased exponentially and show no sign of slowing down. As a result, on the right-hand graphs, where you see, and again, I urge you all to look at these charts separately later on, but you can see that the trend line of spending by corporates, especially, and again, nonprofits and other institutions on actual advocacy in the federal space in the United States. And now we're seeing it in the States, which is part of PPHC's long-term M&A vision as well that we're executing on. But the amount of money that is being spent to manage the interface of government with business to manage, again, risk and opportunity is simply more than ever, and it shows no sign of abating. What has happened is simultaneous with that is we have a very, very complex puzzle that the corporates are facing in trying to manage this environment. And as such, PPHC has set out to create and has created in the United States and will soon in the world the largest network and ability to execute on complex problems and interfacing with government, both on the communications and in the direct relation side. Go ahead, Thomas.
Yep. Here we'll see, yeah, this is our family of brands, essentially, the top of this chart, and it is doing government advocacy, what is in the federal space a highly disclosed, transparent industry, along with a broader integrated services. So we all mentioned our WPP heritage. What we are not is an advertising-led organization. We are a far more client-centric part of the permanent C-suite budgets within many of these brands that you see at the bottom. These are global brands, therefore our aspirations are global, in that these corporates are facing similar challenges and opportunities, on a global axis. Next slide, Roel. Here's just a notion of our scale. Right now we are all US with the endeavor of, so the first question that Roland will ask is why an AIM listing? We're still a small cap stock. The US markets are not that friendly for small cap. The buy and build history of AIM and London was sold to us. Here's our scale now, 2 years post IPO. We have this anchor of government relations disclosed either on the federal or state programs of disclosure, roughly $100 million. This is reporting as of, right? This is full year. Diversified services, which is a new category just based on the acquisitions that we're putting together that are more of a subscription-like content-led monitoring suite of services that clients add to. We then have what you all, particularly if you're all Brits, which we assume public affairs, which is the higher end communications PR services that are immediately adjacent to this policy, sort of stakeholder communications axis for our corporates. Again, think of those big brands from the lot before. We serve clients across all categories. We are driven by tech, energy and renewals, pharma, healthcare, manufacturing, et cetera. It's a 1,200 client roster. Again, half of the Fortune 100, roughly half, 40 odd. The largest client in it, 1.6%. So we have a remarkably broad client portfolio for a professional services platform, but with very little concentration and very deep anchors still into both renewal and upsell ability within these corporate wallets. We focus a lot on the clients of $100,000 or more. It's not a big number, but it's sizable enough to show an annual retained heavy and profitable revenue into those wallets. And you see here, as we're building more things to the arsenal, that number increases based on the cross sell of the platform of strategic we have. Go ahead, sorry, Roel. This is, as Stewart said, 10 years in the making. We like this slide because it just does show always organic growth every year and bringing in the growth by acquisition thoughtfully without duplicative assets. But going back to our founding, this was very much a 1 + 1 = 3 model. We then, as we said, IPO'd 2 years ago onto AIM. Next slide. Finally, for me, is that we talk of this lobbying, this transparent ledger that the federal government in the US keeps. It is defined by Senate law. Therefore, the work we do, down to the issue, the person and the client that pays for it, is subject to quarterly disclosures. We've added the post-IPO, the financial disclosures are required by market to really be the stable pair of hands on a bipartisan basis to deal with the most important audience to many of these corporates. Three of our firms here that you see highlighted are within the more than 2,300 firms that register the top 20. We are combined the largest in the DC space. We compete more and more for clients and talent with some of these brands that you see on the right, big PR brands or holding company brands that aren't as strong in Washington anymore and have turned more into advertising agencies. At broad strokes, we're very focused on, based on our previous experience, this important piece of their budgets, corporate budgets, and are starting there and building outward.
I'll take you through some of our 2023 results, high level, which we published in mid-March. So as you've already seen, we're a $135 million revenue company, and in 23 we grew that by 24%. 2% of that was driven, organically, and the remainder from 2 acquisitions, Multistate and KP, which we did in 22 and in 23. We converted quite a bit of that revenue into profits. You see our EBITDA number of $35 million. So we're very profitable. As a percentage of revenue, that's 26%. And then after tax, that number becomes 26.5 million. We also look very much at our EPS because everything we do is meant to be EPS accretive. We're generating now 23 cents roundabout per share in profit. And of that, we're paying 14 cents in dividend. So that means we're paying about 2/3 of our profits out as dividends. Paying a very good dividend is an important part of our strategy, which really benefits our shareholders. I'm going to skip over these 2 very detailed slides, leave that for your own perusal in your own time. I do want to go here to our long-term perspective. The top chart on the left is our revenue, and you've already seen that. Indeed, I do want to call out that actually, indeed, every year there was a little bit of organic growth, sometimes a bit more, sometimes a bit less. But in any case, throughout political cycles, we will show growth because any change in power is typically good for our business. Now, at the bottom, you see our profit development. The blue bars depict the absolute profit, which was a growing line up till 22. There we took a bit of a pause in profit growth, but that was really attributable to us going public, in December 2021, and we had to add on some public company costs and invested actually in our holding. And then in 23, we resumed our profit growth. As a percentage of revenue, you see them here shown, those numbers that are in gray with gray dots. We're typically aiming for between 25 and 30% profitability. Last year we were at 26, but we're steering our company towards always achieving somewhere between 25 and 30. Thomas.
Our thesis, as we are operators who have both the experience of having sold business and bringing more of the financial acumen to operate at scale. So what we sell into a fragmented industry of advisors is a chance to have a substantial sort of equity portion and a platform for growth of specialty comm services. So we're making investments in talent, as well as in our brands that we've brought on. So adding practices and capabilities to brands after acquisition is part of it, as well as supporting the cross-sell of how our portfolio is working together to solve for sort of global issues, Sacramento to Brussels, London to Washington, figuring out where the client wallet can best be integrated and served. This is, next slide, a remarkably global set of challenges. Fascinating to be on a platform today with two very different companies in the biotech pharma space and in the materials and land redevelopment and whatever category you would call it, are very sensitive to government issues and more opportunities when we're talking about everything from biopharma to minerals. So that axis of government connectivity and stakeholder engagement is a global reality from Washington to Brussels to Germany, et cetera, all Western developed worlds reaching Far East. What we see in the US is a high bar for the level of transparency that goes into the traditional lobbying, that's access to direct stakeholders. What is growing around the world, represented by the red bar here, is the communication services supporting those policy initiatives and those sort of corporate government axes. So very much a swim lane that is ever more connected around policy themes and regulatory trends.
So indeed, as Thomas already mentioned, alongside organic growth, M&A growth will always be a very important component of our strategy. And we've actually have expanded our M&A bandwidth through really amping up our strategy of what we call disciplined expansion into areas where we really need it and at terms that are favorable to our shareholders. So we're looking for acquisitions along two axes. On the one hand, geography, and Thomas already mentioned we're looking in certain European capitals, but we're also still looking to further expand into some targeted US states, such as Florida, Texas, and the state of New York. And then there's certain specializations, capabilities that we're looking to bring into our tent because they would really complement our other groups and would lead to a lot of cross referrals. Now, when we are looking at M&A, and structuring our transactions, we typically use earn-out transactions, and that's very very often used, of course, in professional services. But the big difference in how we structure it is we will always pay with a mix of cash and shares, so that at the end of an earn-out, those who sold the company to us have become very substantial shareholders in PPHC, which we know brings a certain level of stability to our shareholder base, but also therefore to our employee base. Of course, those earnouts are structured in a way that basically if there's no growth following our acquisition, then there won't be any payment anymore. So only growth will lead to further earnout payments. As I mentioned, we pay then in mix of shares and cash. And the cash we're sourcing partly from our balance sheet and partly via bank debt. We have a very good working relationship with Bank of America, who will allow us to go to a level of, in the case, 1 times EBITDA. Now we're far away from that level, but even at 1.5 times EBITDA, that's still very comfortable and conservative in our view. But having that facility really gives us a lot of flexibility and dry powder for us to execute on our M&A strategy. Okay, we have a track record. We're building a track record of improving our operations after they've been acquired. I will not go into any details here, but you will be able to read in the deck that basically for both KP and Multistate, which were two acquisitions that we did post IPO, we've really been able to dramatically improve their top line and bottom line performance. And then you see a third acquisition, Lucas Public Affairs, that was only announced last week, another company in California, which is, as Thomas already mentioned, a very important part of our strategy, because there's so much regulatory developments and legislative developments that originate from California. In any case, of course, too early to tell how their performance is going to develop, but we're very confident that they will follow in the same line as KP and Multistate. Good, handing it back over to Stewart.
Thank you, Roel. I appreciate it. Just briefly, I just wanted to point out on this slide, this was a publication from Politico last year, Politico Europe, though, which really shows, again, the global nature of these challenges that corporates and NGOs are dealing with now. And it really was published, again, for a very specific audience over here. But it shows that, as I said, these issues are just not local. When I started out in my business years ago as a federal advocate, the world revolved around Washington, D.C. and policy making. It no longer does. Roel just mentioned we've now purchased our second asset in California, which is almost operates in our federal system like a country unto itself. And what we frequently find is the issues in Sacramento are more relevant in Brussels than they actually are in Washington. So again, dispersion and diversity of location as well as capability is absolutely critical to us. So again, this market is a huge part of our build out of our global network. Go ahead. Just quickly to reemphasize, our metrics and our guidance, and our board recently reaffirmed this. Our goal is always to try to grow 5 to 10% off our organic base each year, and then obviously add incremental growth through M&A activities. And then again, as Roel said, maintain that EBITDA margin between about 25 to 30%, which has been our historical band range going back even before the IPO. And just a few quick things to sum up, and then we'd love to take your questions. As Thomas mentioned earlier on our client makeup, our client roster, it is a business that is not terribly economically cyclical. Our relationship with our clients are very stable and sticky. We renew revenue at 85% a year. We're not really subject to what happens in political cycles, other than when one house of Congress or the other might change hands, sets off a lot of activity, usually good for our business. Again, we're a very profitable company, and we turn cash very quickly, pay an attractive dividend, and we really, really do feel that we are now the lead consolidator in this business, to provide the comprehensive solutions of very, very complex communications and policy space that our clients are desperately needing, whether that be for long-term engagement with the government audience, or to handle a crisis, or be opportunistic in terms of making their businesses successful.
Okay, Thomas, Stewart, Roel, thank you very much indeed. Quite a few questions here. There's quite a few about all around M&A, and the one for me initially is how do you retain culture when you in a transaction? Do you try to keep the entrepreneurial spirit of some of these firms? You try and get them to go to the PPHC way? What's your approach to culture and M&A? It's
really, Roel, and that's a great question, because ironically, the three of us were passing around an article about this earlier this afternoon. But the fact is that we have a very, very, I should say, well thought out and long-standing philosophy. Part of this stems back to Thomas and I and some of our other founding partners' original experience with having sold a professional services company to a very, very large conglomerate, in our case, WPP, which was primarily advertising and PR, and we were kind of the odd fit there. even though again we made we made by at least profit margin standards, we did very well. That being said, we are firm believers that not all of these types of businesses are the same. That we cannot treat a public affairs firm that does only communications the same as we can treat a federal lobbying firm that can run sometimes pre-bonus 50% margins. So we have to respect the culture. We believe brand integrity is extremely important for conflict mitigation, and that has proven to be the case as well. So we are very, very strong on actually preserving culture, while at the same time, obviously providing the guidance and the financial management and operational consolidation at the holding company level. So it's a fine balance, but we are first and foremost about culture. That's why employee ownership is important. That's why every deal has equity involved in it at the front end and the back side, because we want employee ownerships, and we want people to buy into a common vision, a common financial future, despite the differences in the cultures of the companies.
And on that, next question is, how long is the earnout process typically? And then further, are there any locks in place for shares issued around acquisitions?
To take that question, a typical earnout runs for about 5 years. And indeed, the equity that will be paid as part of that earnout then has subsequently another lock-in for 4 years. So in total, you're talking about a 9 years window that in any case, you can be reasonably assured people will stay around.
The next question is quite detailed, so I want to make sure I get the gist of it correctly. So I'm going to read it out word for word. You said you want to make acquisitions in Europe, and I presume these companies will have European customer bases. Is the longer term goal to cross-sell European services to US customers and US services to European customers? Are there limitations to achieving this, like the FARA, Foreign Agent Registration Act in the US?
Go ahead, Thomas.
An informed question, a good one. We centralize FARA. We do very little FARA work within the existing base of business. Not all corporates sort of subject to that. That's working for foreign agents and government. So while we don't block it, we do manage it with even a higher level of scrutiny as to not, we're focusing on the corporate Fortune 1000 spend, which are increasingly addressing these issues politically with a broader global axis. Because whether it's at trade policies or at the Milken Institute, there's global thought leaders, stakeholders, and government officials that are setting these parameters. So at all levels, we have to operate within the bounds of the law and then have even heightened disclosures based on our PubCo status. Does that answer the bulk of the?
I hope so.
Well, I'll just add real quickly, though, the cross-sell is absolutely critically important, but it's not even as much cross-selling as it's cross-capability. Again, when I started in the direct advocacy business, there was one person in an office working for a corporation in Washington, and they had a team of outside advocates, and they would put the team to work, and the team could actually be quite successful if it had the right people on it. That is not the case anymore. There's, you have to provide the communications, the media management backup, the data, the constituency mobilization, all that is so important in a disrupted digital conversation sphere that exists within policy debates now. And then again, the geographic dispersion. What used to be issues only in Washington are now issues more in California first before they get to Washington. And what our clients are increasingly seeing is that they are facing the same exact challenge simultaneously in multiple international and state capitals. So really, again, we believe that these are actually, it's more of a comprehensive network for our existing clients as much as anything else.
And final question, and it's another one from me, and it's about the customer base. Do you do much with defence, and are there any sectors that you're have a greater opportunity for you, ones where you think you've got opportunity to grow? Any stand out particularly?
I mean, we do defense and aerospace work, obviously, primarily U.S. Defense and aerospace companies doing business with the Pentagon. It is a significant practice for a couple of our lobbying firms and a couple of our comms firms. But in terms of growth opportunities, as Thomas said, when you had that wheel chart up there earlier, we are literally in almost every area. where we think, again, and it's because our clients are really in a constant steady state engagement, no matter what their specialty field is with government, and a constant conversation. The real key to growth is going to be, in terms of new opportunities, will be what is the next issue that's going to pop up. Privacy was not considered an important tech issue, 20 years ago when they first started, engaging, the Silicon Valley groups first started engaging. We see the AI disruption issues. So now we're seeing, AI legislation all over the global map. So these are all, there will always be emerging areas, sometimes driven by technology, sometimes just driven by societal attitude changes. But our clients really are constantly dealing with these license to operate issues. So it's maybe not as much sometimes as about growing new clients as it's going to be continuing to address their ongoing challenges that will not stop in the global environment we're in.
Very good. Gentlemen, Thomas, Stewart, Roel, thank you all very much indeed for joining us. Thank you for the presentation. That's really interesting.